Hey there, everyone. Ryan Schul here. Welcome to my channel. It's all about advanced analytics and things related to this. So, in the project today, I want to talk about how to calculate prices for life insurance premiums. And we'll be using Python as always, right? All of these examples, with just a handful of exceptions, are based on Python, right? So, what is life insurance? Basically, life insurance premiums are calculated by an insurance company. They use a process called underwriting, which assesses and addresses the risk associated with insuring an individual's life, right? So, if they pass an untimely death, the proceeds go to the family or whatever beneficiary is designated, right? And the family, usually it's the family, the surviving spouse can maintain their lifestyle. They can stay in their house. They won't be evicted because they can't pay the mortgage. The child can expect to go to college if that's their goal, or at least have a normal life until the child reaches the age of 18, and then they can determine what they want to do, go to work, go to college, do something else, right? But at least it gives you a buffer to plan for the future and to maintain the lifestyle that you have become accustomed to, right? If the primary income earner, passes away in an untimely death and the family has no life insurance policy in place, your life will be turned upside down, right? So to prevent that from happening, people pay a small premium every month or every year for this life insurance policy, and it's just a security blanket, right? It's a guarantee. If the primary income earner passes an untimely death, the family will be okay. They will maintain their current lifestyle, right? So we can use machine learning to help us predict and price premiums for newly issued life insurance policies, and this can significantly improve the accuracy of the analysis that's being done in terms of underwriting the life insurance policy, the risk management, and the business efficiency, right? The whole process of underwriting life insurance policies can be very time consuming. It can be very labor intensive. It can be um, uh, an onerous process. It can take a long time to do this, right? But we can improve the process of the business and make the entire thing much more efficient. So we can have more accurate risk ratings and risk pricing. We can have faster, more automated underwriting processes. We can have better risk segmentation, better risk management, and dynamic risk adjustment, right? Based on the model's ability to learn how to price life insurance premiums over time. So there's another benefit there. Operational efficiency and cost reduction, and just basic regulatory and fairness audits, right? So in the modern day, with all kinds of machine learning pipelines, we can use explainability tools like SHAP. I'll show you how to do that, and justify why a customer pays certain rates for this life insurance coverage, right? And all bias is removed. There's no kind of racial segmentation or gender bias. I mean, like typically women tend to live longer than men, so women on average will pay a lower life insurance premium unless the woman happens to be more advanced in age compared to a male counterpart. Then the life insurance premiums might be pretty close. It might be pretty equal, right? But this whole machine learning process eliminates any kind of bias too, right? So there's several advantages for undertaking this type of analysis, right? So I'm going to go ahead and import some data that is sitting on my desktop. This comes from insurance dataset.csv. Whoops, I hit the wrong button. Insurance dataset.csv. And if I go ahead and open that, I suppose I can open that and just show you what it looks like. If I go here to File Explorer and open this thing on my desktop. Okay, so here it is, insurance data set. So let me open that, just to give you a quick visual here. And I'll show you where to download this file at the end of the Jupyter Notebook. So you have access to that. You can take all this code. I'll share all the code with you guys, and you can take that, copy and paste it into your own Jupyter Notebook environment and run it. And then, of course, make changes and make modifications to the code and see what kind of impact that has on the overall life insurance premium calculations. So we have a few columns here called features in the ML world. So we have age, gender, what is this, annual income, marital status, number of dependents, education, occupation, health score, location, policy type, previous claims, vehicle age, right? So that's for your car. How old is the car? Credit score, insurance duration, premium amount, policy start date, customer feedback, smoking, yes or no. That's a big one, right? If you're a smoker, life insurance premiums are going to be higher, guaranteed. If you're not a smoker, it's going to be lower. Exercise frequently, And you can start to imagine like how all these features play into the ultimate pricing of a life insurance policy, right? If you exercise a lot and you're in good health, your premiums are going to be lower. If you never exercise and you live a very sedentary lifestyle, your insurance premiums are going to be higher. That's just common sense, right? Property type, condo, house. I don't know exactly how that plays into it. Presumably, if you rent an apartment, maybe that's slightly higher risk. You don't have the higher income required to buy a condo or to buy a house. You might be higher risk, slightly higher risk for the life insurance company. But this person might have a lower age. They're just starting out after college, just starting their career. They haven't saved up a little bit to create a nest egg to buy a house or to buy a condo, right? So it's a pretty complex sort of scenario, but using some basic ML concepts and some data science methodologies, we're going to slice through this and go ahead and um, simulate pricing life insurance policies, and I'll show you actually how easy it can be. So, and one more caveat here, maybe not a caveat per se, but I started my career in life insurance, selling life insurance policies. That was my first job after graduating from college. I thought the concept was actually fascinating. I was very endeavored and enamored by the whole business, the operation of um, creating life insurance policies for the benefit of the beneficiaries, right, and for the insured, for peace of mind. And I just thought it was so fascinating. I went all in for 6 months. I sold or I tried to sell a bunch of life insurance policies. I don't even know if I actually sold any, to tell you the truth. This was a long time ago, probably 25 years ago I got started. I don't even know if I sold one single policy. I love the mechanics and the engineering and the concept, the mathematics, and the statistics behind life insurance, and all the mechanics of how you price a policy, how you manage the risk, how you do all the calculations. I thought that was fascinating. In terms of selling, I was a horrible salesperson. I don't think I sold a single one, to tell you the truth. And my boss said, listen, you can say I'm bored if you want, but he's paying me nothing, right? I'm literally earning no money day to day. And my bank account was getting drained because I had no income and constant expenses. So I think I just walked away. I don't think I got laid off. I don't think you can get laid off in the life insurance business because it's all commission based, right? If you want to do it, you do it. If you don't, you don't. They don't pay you anything unless you have sales. If you have sales, you get paid. If you have no sales, you don't get paid. Nobody really cares, right? So I think I did that for 6 months and just walked away as um, depleted my bank account, and I had to go in a different direction. But I think the business is fascinating, and I would love to show you the ins and outs of how this works. Okay, so Control Enter to run in Excel. So we can see gender, marital status, education level. So we're starting to populate these different features in the data set here. Okay, so what we're doing basically is taking non-numeric features like marital status. This is married, single, divorced. Gender is male, female, right? So the computer doesn't know male, female, married, single, divorced, has no idea what a master's degree is, bachelor's, PhD. The computer has no concept whatsoever of these text features. Urban, comprehensive policy type, right? Doesn't know what this is. So we have to take this and do one-hot encoding on all of this data so we can convert all of these non-numeric columns. If you look carefully, we'll have age, annual income, number of dependents, occupation, health score, and then what previous claims, vehicle age, over to insurance duration and premium amount. So everything gets pushed over to the left, right? And then everything that is not numeric, like gender and marital status and education level, becomes one-hot encoded. So we have gender male, true or false, and marital status true or false. Marital status married. Oh, marital status divorced, marital status married, marital status single. We have gender male, true or false. Female is assumed because there's only two genders there. Education level, high school, true or false. True or false, PhD level, occupation employed, true or false. So we take all of these non-numerics, right? Male, female, married, single, divorced, and convert this into a binary representation of that feature. So is it gender male, true or false? If it's true male, then false would be female. That's implied. Marital status, married, true or false. Single, true or false. Divorced, true or false, right? So that's how we get these over here. Married, single, true or false, marital status, married, true or false, marital status, single, true or false, married status, divorced, true or false. So we take everything that's not numeric, and convert that into a binary representation of the original, encoding married, um, marital status, married, divorced, or what was it, single, and then male, female. So all the numerics stay numerics, all the non-numerics are converted into binary representations of that field, okay? And we use one-hot encoding to encode all non-numeric features, so we can create a data frame with a bunch of features that will be interpreted by a regression model. We're going to set up a regression model because this is continuous data, right? Discrete data would be something like classified data. It could be a banana, orange, pineapple, coconut, something like that. That would be labeled data. If it's size of clothes, it could be extra small, small, medium, large, extra large, right? Those are representations of sizes and classifications of sizes. And that also determines a hierarchy too. So small, medium, large means large is bigger than medium, medium is bigger than small. But if you have something like marital status, if I go back over here, marital status, married, single, divorced, you can't say married is a 2 and a single is a 1 and a divorce is 0. That would imply that divorce is less than single and single is double divorced and married is double of single, right? That doesn't make any sense whatsoever. If you have a hierarchical relationship like large, medium, small, you can tell bigger, medium, and small kind of follow a hierarchy. Marital status has no hierarchy whatsoever, okay? You can't say married is twice as good as single and single is twice as good as divorce. It doesn't make any sense. If you go over here to PhD level or education level, you can't say a PhD is double a master's degree and a master's over here is double a bachelor's degree. There's no hierarchy between those. You can say you spend a little bit more time in school for a PhD and you might earn a little bit more money as a PhD graduate than a master's student or a person that holds a bachelor's. So there might be like a hierarchy in terms of income, but in terms of labeling, a PhD is not double a master's and a master's is not double a bachelor's. So we have to use one-hot encoding. I have another whole video that goes into all kinds of encoding scenarios. It's basically 3: one-hot encoding, categorical encoding, and label encoding, right? So there's reasons that you should use each of those 3 in different scenarios, given different assumptions. But in some assumptions, one will perform better than the other, right? So you really have to understand the objective you're trying to achieve here. And we're not looking at hierarchical classes. If this is large, medium, and small, we can use label encoding or categorical encoding. In this case, there's no hierarchical representation between the features. So I'm going to use one-hot encoding and just get trues and falses over here, okay? So I have some notes over here. Education level, high school could be 0, bachelor's could be 1, master's is 2, and PhD is 3 if you use label encoding. But again, that doesn't make any sense. A PhD is not twice as good as a master's, and master's is not twice as good as a bachelor's, so you have to use one-hot encoding. So check out the notes. If that doesn't make sense, do some Googling. I think after a little research, that should make sense for you, okay? So looking at the premium amount, that's what I'm trying to predict, right? How much life insurance premium do we pay given the age, the annual income, number of dependents, health score, all of these features over here? What actually has a statistical impact on the premium that we pay for a life insurance policy? That's what we're trying to determine. So I'm looking at the distribution of returns, and you can see the premium amount in most cases is close to 0. Some people pay up to 1,000 if you look in the x-axis, 2,000, 3,000, 4,000. One guy actually pays $5,000. So this is an anomaly and an outlier, and that is going to skew all the data to the right-hand side. This is called a right-hand skew because we have a fat tail, or the tail skews over to the right. If the tail skews over to the left, then you have a long left tail, that's a left skew, right? But that is going to impact the ability to make predictions because the model is going to look at a couple of life insurance premiums for these policies that pay $5,000 a year and say, okay, I have to understand how to incorporate that into the model and how to assimilate that with the rest of the life insurance premiums whereby the majority is less than 1,000 per year, okay? So if the annual premium mostly is 1,000 per year, but you have a couple that skew up to 4,000, 5,000, it's going to distort the model and make the model struggle to make accurate predictions. So one way to handle this is to take the log normal distribution of life insurance premiums because we have this big skew, okay? So I'm taking right here the NumPy log normal distribution of premium amount, right? I'm trying to highlight that. What's going on with my mouse here? It's not letting me, let me do it. Okay, here we go. So we have the premium amount. We're taking the log premium and then plotting the log premium into 50 bins and looking at the distribution. So once we take the log normal distribution, we can actually use this feature as a predictive target variable right here. We can look at the premiums, but if you have this big skew to the right or big skew to the left, it's going to distort the whole model and the model won't be able to accurately make these predictions, right? So we have to handle this somehow. Another way to try to handle this skew data is to Winsorize outliers, or basically remove the outliers, right? Because these are extreme examples. These are anomalies. We want to get that out of the data set before we train the model. So you can say the lower quartile, anything below quartile 0.01. So if you have a lower 1% of life insurance premium prices falling into this bucket, let's just kick it out. Let's remove it, okay? Because that's not going to help the model. It's just going to distort everything. If you have higher than 0.99%, so any policy that pays over or is priced over $5,000 per year, that is really unusual. It's going to distort the model. We have to kick it out. So we're going to take everything greater than the low and less than the high. That's another way to handle these distortions, right? And to make everything more standardized and more normalized. So another way literally is to scale the data. We can take take a standard scalar. We have standard scalar here. We're setting this up. We're going to feed everything into the X variable. So the X variable has already been defined, I believe, over here. Oh, has not been defined. Okay, so we're setting up the X variable to automatically scale all the data or normalize the data. So X is going to be, let me see, X scale is right here, Control F. Yeah, I never even used it. Okay, so in this case, I set up the problem. I never even used the data. I'm using a different approach. I'm just showing you a few different ways to handle these outliers and these extreme examples. So take the log normal distribution, Winsorize, scale the data or normalize. Okay, that's almost the same thing. There's slight differences there. So I think standardize goes from 0 to 1 and normalize goes from -1 to +1 or vice versa. I forgot the definition right now. I've done this a bit in the past. I don't do this every single day. You can Google that. You can standardize or normalize the data. Either one is fine. It'll just take everything that has all these extreme outliers and get it more into a structure where the data is essentially similar to all the other data points, right? So you don't drop data points necessarily, but you go ahead and create something that is more feasible for the model to be trained on and to be tested on. So I just saw like a weird thing over here. I'm going to go ahead and refresh this data and pull this in again. I'm going to go ahead and get the dummy data over here. Okay, Control Enter. Okay, so everything is one hot encoded at this point. So again, there's a few ways to handle this. You can take the log normal distribution. That's one option. I don't actually want to do that in this case. You can Winsorize the data and remove all the higher extreme data points and all the low extreme data points. That's another option. You can standardize or normalize the data. That's another option. I am going to go ahead and run this light XGBoost classifier right here. Let me see if scaling can help me. No, it actually didn't. Wait a second. Give me a second here. Let me try to Winsorize the data to take those out. And it says premium log. Oh, yeah, because I didn't get the log aspect. Okay, so let me get the premium. This is good. So I had a bunch of different things. I was kind of flipping back and forth. It gets a little dangerous when you do these things, right? You have to keep your wits about you. Okay, so the data's been trained and tested. Now let's feed it into the model and see what kind of results we get. Still low, still low. So let me look at something here. Let me look at something. Let me actually take the premium log, okay, and I'll go switch back to that. Okay, I'm trying to juggle a lot of balls here, and I don't need that. Let me use that over here as the X variable. I'm going to drop that, and I'm going to set that as the target variable. So if this is done, do I have my charts over here? No, it's still working. Okay, so I need to see a couple charts so I know it's done. Okay, there's the regular distribution, and the log normal is coming up. Okay, so there's the log distribution. I'm going to feed that log premium into my model here and get the results. Yes. Okay. So there's the training testing. Okay. And that's what I want. So I tried a few different scenarios. In the end, there's a few things you can do. Okay. So you can use winterization to remove the top 1% and the bottom 1%. You can take the log normal distribution. That's what I ended up doing. Okay. Just again, to get everything on the same relative scale. If you have extreme outliers, everything gets pulled into the middle and you don't lose like the degree of extremeness from one data point to another, but you don't have one data point that's 10,000 when most are 1,000, right? So you take the same relative scale and compress everything into a log normal distribution. This eliminates the top 1% and bottom 1%. So I'm going to scale the data. And again, if you want to standardize, that's another option. I tested this. This seems to work pretty well. I'm taking the premium log, which I calculated right here. Okay, it's a little complicated. I get it. I totally get it. Try to follow along. Take the premium log here. I'm skipping this step right here, and I'm using the standard scalar and the premium log together. Okay, and I'm dropping premium log because that is the target variable that I'm trying to predict, and I'm using this as my y variable, the premium log, and I'm running the light LGB gradient booster regression algorithm. There's a few that I tend to lean towards for most of my analysis. LGB is great. XGB, extreme gradient booster, random forest regressor is good. So when I run this, I get a accuracy of 0.9996. So very accurate in terms of the model's ability to make predictions. 99.96% confident that when this model makes a prediction, it's going to be correct and it's going to be pretty accurate. So another way to remove some kind of outliers is if you have a credit score greater than 600 or a health score greater than 30, we want to keep these. So these are like the preferred customers, right? So a higher credit score is better. The person probably takes care of themselves, has a good job, financially responsible, pays their credit card bills on time, probably has a mortgage on a house or a condo. That is a risk that we're willing to underwrite, right? If you are barely scraping by, have a low credit score, maybe who knows, maybe homeless person, is that really the kind of risk that you want to underwrite? Probably not, right? So it is a little bit biased, but again, it's a profitable business. We have to show profitability. If we underwrite every person that walks in the door, the underwriting team will probably be like, oh, we don't need an underwriting team. If every single person that applies for insurance gets the insurance, that's going to be bad for business. You're going to have some high risk on your books, right? And you don't really want that. So you don't want to turn people away, but they have to be somewhat qualified for life insurance, right? If the person is totally unqualified, drug abuser, alcoholic, and has no home to live in, that's probably not the type of risk you're willing to underwrite, right? So you want to look for high credit score, high health score above 30, right? That's a healthier person. They take care of their own body. They invest in themselves. They eat well. They exercise. They're self-aware. Self-awareness is somewhat rare in our society today, right? Person's self-aware. They take care of themselves. They understand their body. They understand their persona. They're willing to take care of themselves. So that is something that the life insurance company is interested in doing business with, right? You don't want some random risk. You want somebody that takes care of themselves. You want somebody with a high credit score, right? So you want to define the profile that is going to be good for your book of business. So here's another way of doing the regression. I just told you the first one was, let me get this one working because I know this one takes a few minutes. So the first one was LGB regressor. So we got 0.9996, so 99.96% accurate. It's pretty high degree of accuracy. This is an XGBoost regressor, so extreme gradient boost regressor. In this case, we have, again, 0.9996. This ends in 976. This ends in 632. So they're pretty close, slightly different methodology, slightly different terms of slightly different result for the R-squared. The R-squared shows you the goodness of fit. The mean average error shows you the average error for all the life insurance policies. You want the MAE to be lower, lower is better. You want the R-squared to be higher, higher is better. Okay, over here, the MAE is 0.0075271. Here, 0.00760. So again, very low MAE, very high R-squared. So the model is able to train and test and make very accurate predictions. So here, the MAE is actually smaller, 0.914 to the negative 0.05. So this would be 0.0000914. I think that's how you represent that in scientific notation. And here the accuracy is even better, 0.999999. So 6 degrees after the decimal place, 6 degrees of precision after the decimal place, accuracy. You know what? That's totally fine for me. If I get 0.969798, I'm fine. 99, I'm thrilled. So let's move forward to the next step here. We're going to create a feature importance exercise so we can see of all the features in the entire data frame which have the most statistical influence on the target variable. So remember, we one hot encoded these. So age, annual income, number of dependents, health score, previous claims, vehicle age, so on and so forth. I don't have to read every single feature to you. We are trying to predict this variable right here. Where is it? Premium amount. Okay, so we're trying to predict the premium amount. We want to see which features have the most significantly statistical impact on the premium amount, right? So looking at that data frame, I can't tell. I have no idea what this is. But when we run this feature importance exercise, this random forest regressor, again, I'm using the random forest regressor, which was trained and tested right here. Okay, random forest regressor ran. We are fitting the model right here. We fit the model. And then we're using this RF model, Control F, Control V to paste, RF model predict. We're using this to make predictions into the future. And the Y predict RF is random forest. Y predict random forest is the Y target variable, the price that we're predicting based on this model that has been trained and tested and fit right here. Okay, so everything kind of cascades down. You can see how it fits together. So yeah, at this point, we're doing the random forest feature importance exercise to see which features have the most statistical influence on the target variable, which is prices. So health score, annual income, credit, age, vehicle, insurance duration, number of dependents, previous claims, gender, male. And you see the percentage. This is 14%, 13, 12. In descending order, it goes down to 1% influence from marital status single. So that's a lot of stuff. I just want to look at the top 10. I can take the head of the data frame, the top 10, goes from health score down to smoking, status, yes or no. Totally makes sense. If you're a smoker, probably the insurance company is not too interested in insuring you. You can still get the insurance, right? You can get that if you want that and if you need that, but they're going to charge you a higher premium if you're a smoker. Again, males and females are going to pay different. Just females tend to live longer than males. It's just human nature. Vehicle age, age of the person has a huge influence on the policy. The older the person is, probably the less life they have ahead of them. That's just common sense, right? So an older person can apply for life insurance and can qualify, but they're going to pay a higher premium. Credit score, if you're fiscally responsible, you pay a lower premium. Annual income, if you have more money, you would pay a lower income, right? It seems like these type of people that are more affluent or more successful, they take care of themselves, they have more of a vested interest for being around for their family into the future, right? If somebody buys life insurance, I think the cutoff for suicide is 2 years. It would really depend on the contract and your specific insurance carrier, but I think usually it's 2 years. Obviously, an insurance company doesn't want to write a policy on somebody that is suicidal. But if you get the policy, you wait 2 years and you commit suicide, in most cases, the company will pay out, right? But they're not going to pay out if you commit suicide 1 week after you qualify for life insurance, right? It's not going to happen. So we can get the top 10. We can go ahead and get the feature importance plotted here. So I always say a picture is worth 1,000 words. You can see the feature importance here. Feature health score is 14% influence on the target variable. The feature of annual income has a 13% influence on the target, and the credit score has it's hard to read this thing, 10, 11, 12%, and the age has 10% importance on the target variable. And vehicle age, just to get the top 5 here, is 8%. Okay, so cumulatively, you get all the percentages that feed into determining the total cost of the life insurance policy, right? So here we can understand what the model is doing. We're going to go ahead and do a SHAP exercise. So when we look at SHAP values, we can look at the model that's printed out. We'll have red and blue dots that look kind of like a beehive. It's called a bee swarm plot. You'll see that in just a moment here. So the reds go to the right and they push up that feature to the right. The blues go to the left, and they pull down the feature to the left. So red is more important. Blue is less important. If you have more red dots on the right-hand side, this is pulling up the feature, making it more important in terms of predicting the target variable. Remember, that's the price for the life insurance policy. It's the price that we're paying. And on the other hand, if blues are dragging it down, then that is less important for the ultimate premium that will be charged to all the customers here, right? So each dot represents a single prediction. On the rows, you'll see this in a minute when the chart is rendered. And again, red is high value and blue is low value. The further the dot is from 0, the 0 is kind of the median in between, the more impact that feature has on the predictive capabilities of the model, right? The model to predict the price that we should charge for this life insurance. Positive SHAP values push the prediction higher over to the right, and negative SHAP values, which are represented by blue dots, pull that to the left and make that prediction power lower, right? If it's red, prediction power is higher, blue, prediction power is lower. And we look at the features as they're ranked from the highest at the top down to the bottom, and the average importance for all of the features in the whole feature mix here, right? So a graph should be coming up in just a moment, and we'll see the features like age, annual income, health score, which features have the highest influence on the target variable. And this is nice because it shows us a visual representation. Again, a picture is worth 1,000 words. So we can see visually, just in a couple of seconds, how all these features impact the price of the life insurance policy, right? So we saw some indication of that over here. Using this methodology, this is a feature importance exercise using random forest. We'll see a similar exercise, kind of a different approach and different perspective, but the results should be mostly similar. If these jive perfectly, then we know everything is copacetic. If they're off a little bit, it's not going to cause us to lose any sleep. But it's just a different method for trying to predict the target variable, right? So here we see the credit score, annual income, health score, these are the top three, age and insurance duration. That is going to have the highest significant impact on the target variable. In terms of blues, remember blues are negative, reds are positive. Health score actually has a negative impact on the target variable. Vehicle age has a positive impact. Gender male has a positive impact. Males will pay higher than females, given the same age, the same health condition, same status as a smoker or not smoker. The age has a slight negative impact, 15.1, and the credit score has a slight positive impact, 13.46. So you can see over here, I ran this previously. I got slightly different numbers. I have 986.96. I'll update this, 986.96. And then the total is going to be 95124. So 95124, 951.24. And the difference is going to be, right, 986, 951. So let me put that up here. I'm going to borrow this Excel sheet to do a quick math problem here. 954.24, right? Okay. And that minus that is negative 32.72. Negative 32.72. And every time you run this analysis, it's going to be slightly different. It's going to be mostly substantially similar, but slightly different, right? Because we have random starting points and the outcome is slightly random too, although it's going to be mostly the same outcome, right? But that's why I had to adjust the numbers. I ran the scenario just before I turned on the recorder, and the outcome was just slightly different. But again, it gives you a good general overview of what impacts the target variable. So now we have the trained model. It's been trained, tested. Everything is working as expected. We're fine. Let's say a person applies for life insurance. The model has been trained, tested, validated, and we're 99.99% confident it can make accurate predictions for life insurance premiums. Person comes to us, age 22. This is a female, income 175K, marital status married, number of dependents to education level, bachelor's degree, employed, health score 80.5 out of 100, lives in rural area, comprehensive coverage for life insurance policy, and 770 credit score, very good credit score. Let's go ahead and run this. Okay, now the advantage to this is the model's trained, tested, making accurate predictions, 99% accurate. If we go to the underwriting team and present this to the underwriting team, all these features in this dictionary, you can tell this is a dictionary because the curly braces, and you have the key and the value pair, key value, key value, key value, right? Everything in this dictionary matches up. The underwriter is going to have to go and do independent research and look historically. Okay, for woman age 22, this income bracket, marital status, so on and so forth, health, rural community, comprehensive coverage, credit score 770. It's going to take a while for that guy or girl, whoever the underwriter is, to go ahead, go do the homework, come back with the results, present the results, and incorporate that into life insurance policy. That's going to take some time. That's going to take some labor. That's going to take some effort. This model just spit out the result to me in about less than a second, right? A fraction of a second. We have the life insurance premium, 99% confident. We charge this person 1152.16. That is the risk we're willing to underwrite at the price we're willing to underwrite the risk. And that's a policy that's going to be issued. That contract will be issued at that price. And then this person, this woman right here, can accept or reject the terms of the contract, right? Now, let's say the person's older. Now, instead of 22, 32, I would expect the premium to go up a little bit, 1152. Okay, all else equal. 1205 went up a little bit. Not huge, but a little bit. If the person is older, 42, now 10 years older than the 22-year-old woman that applied previous, everything else is the same. 1205, run it. 1 second, we get the results 1087. So it actually went down. That sounds a little bit weird. If I decrease this annual income, let's see what kind of impact that's going to have. Again, this profile is similar to what we saw before, slightly different. 97617. Okay, so it is going down a little bit. So maybe like less income, this person, I think I know why, this person would qualify for a lower policy. If you have a higher policy, 175,000, you're going to pay out a much higher overall life insurance benefit, right? If this person has less income, the benefit is going to be lower, so the price for the life insurance premium is going to be lower. If the credit score goes down to 570 instead of 770, it probably goes up a little bit, 858. Yeah, as you see it. So we went from 770, 976 to 570. Let's go to 470, low credit, 470. I would expect this to go up. 858 actually goes down a little bit. Maybe again, like the life insurance coverage will be lower, maybe for lower credit score. The insurer is just willing to underwrite lower coverage on that policy. So that's it. So the model's been trained, tested, spits out a life insurance predicted premium in 1 second. The underwriting team would take, I don't know how long, weeks, maybe a couple of months to get back to us on this. Maybe a few weeks, maybe up to 1 month. I think they have to cap it. It has to be pretty fast turnaround. Otherwise, the competitors are going to swoop in and take away business from us. But anyway, so that's how you train and test the model. You use this to make predictions, right? And the predictions based on this value right here, if you go back here on the random forest model, we have set up, or is it over here? Random forest, yeah. So the random forest regressor runs here. We take the regression between the X train and the Y train. I'm sorry, I looked at the wrong cell. Random forest regressor. We have the model set up here. We fit the model between X train and Y train right there. And we're predicting the X test based on the model and its ability to make predictions into the future. Again, we're predicting the Y variable. We're calling this Y predictive random forest. And that is the price that we're going to charge for the life insurance policy based on all these features that we input on the trained and tested model over here. Okay, one more extreme example. If we go from 22, age 22 down here, the premium is 658 for this person. If we go up to 62, so 40 years older, the premium is going to jump up 866. So not huge jump, but definitely more expensive because the person's older. Just common sense has less time on this earth, and they're not going to be around presumably as long as a 22-year-old. But of course, there could be a catastrophic accident, car accident, some random death occurrence or something like this. There's no guarantee that a 22-year-old person is going to live beyond 62. There's no guarantee that 62-year-old person is going to live for another 20 years, right? There's no promise for tomorrow for any one of us on this planet, right? But historically, you know that a 22-year-old person generally will probably live longer than a 62-year-old person. That is just common sense, right? So without machine learning, predicting life insurance premiums is based on a broad assessment and a bunch of assumptions. It's kind of subjective, although it's mostly objective. But with a machine learning model, it's 100% objective. Healthier individuals might be overcharged, right? That is a bias. As a consequence of dealing with underwriting teams, riskier individuals might be undercharged, right? Creating losses for the life insurance company. Again, there could be a bias or a mistake made with a machine learning algorithm. That doesn't really happen, right? Computers are deterministic. You know what the outcome is going to be, at least given certain statistical parameters before you even make the calculation. And underwriting takes longer and costs more, right? I'm not saying eliminate the underwriting department, but if you couple this this concept and this methodology with your underwriting practices, you can do underwriting much faster and arrive at a common point of interest where maybe this premium might be perceived by the underwriting department as a little bit too low, maybe a little bit too high, but the underwriters can kind of tweak this and adjust that. So I'm not saying eliminate the underwriting component of your business. And you see in the news all this AI layoffs because of AI, all these people are getting laid off. Hopefully that's just like false news or fake news or just like a couple random incidences. But I would say, couple this solution with your underwriting team solution and marry those together, and you're going to have a more accurate, more robust, faster way of underwriting policies and producing a result for the client that needs this life insurance coverage, right? So this is where I collected the data from. You can go ahead and check that out and download the data. That is pretty much it. This one ran up to 41 minutes. I don't want to drag this on any longer. I think we covered all the bases. I think we proved the point and beat this horse to death, okay? So that's it. That's how you do calculations for pricing life insurance premiums using Python. I will save all this code and post this as an HTML file when I post my video later today, so you guys can check that out. And I'm going to wrap it up here, and I'll see you guys in the next video. Look forward to it. Talk to you soon. Goodbye.